So I'm going to talk about, is risk mispriced in a credit boom? So there's been a number of papers through the conference, obviously talking about credit booms, credit growth, and the relationship of that with financial crises. The paper we just saw talking about that, for example. I'm going to very much look at the behavior of asset prices around credit booms. Asset prices are going to be particularly useful because they're going to embed agents' forward-looking expectations about growth and attitudes towards risk. So that will be useful in learning about what some of the drivers of credit booms might be. Credit boom, so a big increase in, let's say, credit to GDP. This was not going to break this out by different components of credit, just aggregate. What we already know here is that that is strongly associated with increased fragility and higher chance of crisis. That thing predicts future financial crises. We've seen that from a number of papers. It's also going to be associated with high asset prices, so high valuations and low future returns in asset markets. And then I'm going to think about whether or not that implies that risk is mispriced in credit booms. I'm going to view that through a very much asset pricing lens. Okay? Now, there's a lot of other papers here that are in this literature. Some of the results that I have are effectively just summarizing those papers. I just want to highlight a few of those. Matt's paper with Wei Zhang is going to be very related here, as well as some of the work that I've done with Arvind Krishnamurthy looking at credit booms and asset prices. I won't continuously cite all of those papers, but this is totally drawing on all that stuff. Okay. So here's the outline for my talk today. I'm going to start by summarizing 3 facts, which is really 2 facts, and the third is going to kind of come from the first 2. So fact number 1 is going to be credit boom. So an increase in credit to GDP is going to be associated with high asset prices and low future returns. That's going to be true for equities, that's going to be true for real estate, and that's going to be true for credit as well. Okay? So when you see an increase in credit to GDP, future expected returns are low. Okay? The second is that credit booms are going to be associated with elevated risk. So for all of these asset classes, when you're in a credit boom, it's more likely that you're going to get something like a left tail event, a crash in the stock market, a crash in real estate prices, or a big spike in credit spreads. Okay? So what does that mean? Lower future returns, lower risk premiums, and elevated risk in this asset pricing lens that I'm going to have. There's going to be, the risk premium is going to be driven by the quantity of risk as well as agents' effective pricing of risk. This is going to mean that the price of risk, agents' effective risk aversion, if you want, is going to have to be really, really low in credit booms to kind of make sense of these 2 facts. And I'm going to talk about, is it sort of too low from a rational perspective? Does it represent mispricing? Okay? So interpretation of the facts, can this price of risk be driven by sort of rational standard models? I'm going to just show some evidence that it's not driven by sort of standard stories about what we think drives variation in the price of risk over time. It's going to be consistent with the view of mispricing, although I'm going to be careful on this. Mispricing is always a little bit tricky. There's not going to be strong, definitive proof of mispricing, and I'll tell you why and exactly how that works. And then I'm going to give some suggested evidence of what might be going on here toward the end. I'm going to show that low past risk, so when the kind of economy has looked safe, low GDP volatility, low stock return volatility, and so on, actually predicts a credit boom, but then also forecasts higher future risk. Okay, so one interpretation of the facts there and kind of what's going on is that when you've had low past risk, agents might view the world as safe. They might endogenously take leverage, extend credit, and so on and so forth, leading to a credit boom. That's going to lead to fragility because of the amount of leverage in the system, and that's going to forecast higher future risk. But the results would suggest that that's not reflected in asset prices. Okay. That's going to be suggestive as a possible story. I'll show you what facts support that and what. Okay. I have to say, when I'm talking about mispricing, we always have to be a little bit careful, especially if you talk to academic financial economists. This is like, those are kind of fighting words in some sense when you talk about mispricing. So why is it really hard to document clear evidence of mispricing? So we always have the joint hypothesis problem from FAMA, which is that we need a model for what asset prices should be before we can say that there's mispricing. Okay? So what do we need to know? We need to know what are the risks that agents sort of should care about, the kind of quantity of risk, and then what's agents' attitudes towards risk and how might that move through time. Okay? So mispricing is always going to be relative to a model. I'm going to say kind of how far can we go? What can we say with the weakest possible assumptions? The weakest possible thing that you could have, the only definition of mispricing that will make someone like FAMA happy is to say that a bubble is a predictable, strong decline in prices. So FAMA's definition, only definition to show clear mispricing, is that you have a risk premium that's less than zero, that you can reliably forecast negative returns because the risk premium should kind of always be weakly positive in any reasonable model. Okay, so maybe disappointingly from this view, which is kind of the weakest view, I'm not going to be able to say that there's clear evidence of mispricing, and I'll show you that. Okay, but still, relative to most of the models that we kind of think about, it will be suggestive that it looks like mispricing. Okay, good. So what's my asset pricing framework? I'm going to have the risk premium on any asset. I'm going to be looking at stocks, real estate, and credit, is equal to the quantity of risk, how risky that particular asset is at any point in time, times the price of risk. You should be thinking about the price of risk as basically agents' effective risk aversion, how much they care about risk or what their attitudes toward risk is. So to make this really clear, here's a kind of classic mean equilibrium model for an agent with CRRA preferences. This is from Merton. So here, the conditional risk premium is equal to gamma, that's the risk aversion of the representative agent, times the conditional variance, times how much risk there is. Okay, so what I'm going to do is use the data to quantify each of these three channels. I'm going to be quantifying the risk premium channel and quantifying this quantity of risk channel. And then the price of risk is going to be kind of a plug that satisfies that equation. So what can we say? How can we characterize the behavior of this price of risk? And then is it reasonable given the models that we usually think about? Okay. So the main findings in a credit boom, the risk premium is low. The quantity of risk looks high. From this equation, the main conclusion is going to be you need the price of risk to be really, really low. You need the effective risk aversion of agents in the economy to be essentially really low. Okay? So where is this coming from? How am I going to show the risk premium is low? Credit growth is going to be negatively forecasting excess returns for equities, credit, and housing. Okay? For quantity of risk, high credit growth is going to positively predict financial crises, crashes in the stock market, crashes in the real estate market, and then it's also going to be predicting drops, declines in consumption or GDP. Okay? So various reasonable ways to try to think about risk, and all of those are effectively going up. Okay? So those two things are going to contribute to the third. All right. And then I'll talk about rational and behavioral and how much. All right. The data that I'm going to use, I'm going to use this JST data set. So thank you for posting all of this online. So you can fairly easily replicate this. And then I'm going to augment this as well. So this has, for 17 advanced economies since 1870, it has credit, GDP, consumption, financial crisis dates. And then in terms of asset pricing, it has equities and housing returns. I'm going to add to that my own data from my work with Arvind Krishnamurthy that has credit spread data for a lot of these overlapping countries. Okay, so I'm going to merge that in as well. The credit spread data is particularly interesting to look at the behavior, the pricing of credit risk in particular in these credit boom episodes. Okay? So let me start with fact one: low risk premiums in credit booms. I'm going to run panel regressions of the future 3-year excess returns above, a riskless rate on different lags of credit growth. Okay? Doesn't have to be 3-year excess returns. You can kind of expand or shrink that window. But that's the results that I'm going to provide here. So low risk premiums and credit boom. So I have kind of 3 measures of credit to GDP, just the level of credit to GDP, the 3-year change, and the 5-year change. I'm going to focus on the 3-year change. This is just showing that it's reasonably robust to using some of these other measures. So we have equity excess returns in panel A, 3-year change in credit to GDP here, and here's the coefficient, -2. So what does that mean? That means when the 3-year change in credit to GDP for a 1 standard deviation change in that variable, the equity premium is about 2% lower than normal. Okay, so the unconditional average for the equity premium in the sample that I have is around 5%. So that means a 1 standard deviation increase in credit to GDP lowers it from 5% down to 3%. So that's actually a pretty sizable effect there. Okay? So economically speaking, the magnitudes there look to be quite large. Okay? You see kind of the same thing with the 5-year. These are the standard errors in parentheses, so statistically significant. And then also here's controlling for the dividend yield. Is this picking up the exact same thing as kind of what you would pick up with the dividend yield? This effectively survives controlling for the dividend yield as well, with about the same magnitude of the coefficient. Okay? Dividend yield is coming in significant here as well, as you would expect with a positive sign. Okay, so that's for equity excess returns. What about housing excess returns? You see effectively the same thing. So now here's change in credit to GDP for over 3 years. 1 standard deviation change in that means a 1% lower return for housing. Okay? And again, statistically significant. Doesn't matter too much if you use the level, these 3-year or the 5-year change. And then that survives if you include things like rent to price or other things like that as well. Okay? Economically, that's pretty big as well, about a 1% decline in that excess return. Behavior of credit spreads around these credit booms. So this is directly from my work with Arvind Krishnamurthy here. It looks like credit spreads around these credit booms and before a financial crisis are something like 23, 25% lower than they are in other normal times. And it looks like actually the spreads are lowest when credit has been kind of growing the most. So the more credit is growing before a financial crisis, it looks like actually the more compressed the lower spreads are. So the lower the risk premiums are. Okay? Let me now turn to the quantity of risk during credit booms. So we've seen that the effective risk premiums are all falling for all of these asset classes. Let's talk about quantity of risk. So I'm going to just have a bunch of ways to think about risk, either in the asset returns or more on the real side. So I'll use the financial crisis dummies from this data set. For some of the returns, I'll use a crash or kind of a left tail event as an indicator for risk. So I'm going to use a dummy for equity returns being below -20%. For real estate returns being below -5%, that's because they have a much lower standard deviation. Okay, so lower cutoff there. For GDP growth, let's say below -2.5%, and same thing for consumption. Okay, all of those cutoffs are chosen so that this kind of crash occurs about 10% of the time for each series. Okay, so it's basically the 10th percentile for each one of those series. And then I'm going to run a regression of any of these indicators on credit growth. So predicting financial crises, this is the top one. We should not be remotely surprised about this. This is well documented in the literature. Change in credit to GDP positively, significantly forecast the chance of a financial crisis going forward. Okay? Looking now at the equity crashes, change in credit to GDP means also an elevated chance of a crash in the stock market. Okay? That's true for kind of all of these different measures of credit to GDP. That's also true when you control for kind of other stuff as well. And then housing crashes, this one got a little bit cut off here, but same thing. Increase in credit to GDP means an elevated chance of a left tail event in the housing market. It means an elevated chance of a crash in real estate. Okay. What about more on the real side? So now I'm predicting declines in GDP. Remember, this is just GDP being below minus 2.5%, something that's occurring about 10% of the time in the sample that I have. And kind of the same thing there, right? So increase in credit to GDP is meaning higher likelihood that GDP is going to fall. Okay. And same thing, a little bit weaker for consumption, but basically the same pattern. Okay. Elevated chance that series is going to drop. Okay. So now let's think about this from this asset pricing perspective again, where we have conditional risk premium being equal to the conditional price of risk times the conditional quantity of risk. I think that these two facts that we've looked at so far are kind of challenging from our usual perspective of how we think about this equation and how we think about this kind of pricing of risk. So the first fact implies that the risk premium falls when credit growth goes up. How much? A 1 standard deviation increase in credit growth says that the risk premium is about half of normal. Okay, so this left-hand side is effectively cut in half in a credit boom. The quantity of risk, a 1 standard deviation increase in credit growth is suggesting that a crash depends on exactly which one of those series that we're looking at, but maybe up to about double what it normally is, maybe 50% to 100% of its normal value. Okay, so significantly elevated probability of a crash. So it looks like you're getting a lower risk premium when the actual quantity of risk is going way up. Okay. So the only way to square that, if you want to square it from a rational asset pricing perspective, is you need this price of risk variable to be falling dramatically. Okay? So you need the price of risk to be really low in credit booms. And then whether or not that's rational or mispricing, I'll talk about now. Okay. Now, of course, when we're thinking about this as being possibly mispricing, we're measuring this as an econometrician looking at the data. It could well be, from a behavioral perspective, that agents' view of the quantity of risk at time t is really low, even though it's actually really high. They're rationally, in their minds, demanding a low risk premium because they think this object is really low, but when we go to the data, we measure it as being high. Okay, so all of those biases are going to just end up in this price of risk plug that I have here effectively. So that price of risk will encapsulate either agents' rational risk pricing or will encapsulate all the biases that agents may have. Okay. So I want to come back to this issue of mispricing from Fama. Is there kind of this smoking gun evidence of mispricing here? So here's Fama's quote again, saying a bubble is a predictable strong decline in prices. Idea basically being under rational models that price of risk is always weakly positive, so that the risk premium being negative would be a mispricing or a bubble. That's the only clear instance that you can say it's a bubble. Okay? So here are risk premiums negative in credit booms. So looking at this, I just took average excess returns on equities, housing, and then looked at credit spreads when credit growth was above, let's say, 90th percentile. Okay. And they are low. For equities, the point estimate is negative. For housing, it's slightly positive. But they're not reliably negative. It's not easy to predict. For equities, the t-statistic is, you can't say that this thing is different from 0. Okay? This differs a little bit from the paper that Matt has with Wei Zhang, the Barron and Zhang paper. But their conclusion is mainly coming from looking at bank stocks in particular. So for bank stocks in particular, it looks like you can reliably forecast a negative return in periods of credit booms. For these broad asset classes, it doesn't look like the returns are reliably negative. Still a puzzle if you're getting a risk premium that's basically neither of these are significant, so it's a risk premium close to zero, and you're facing a lot more risk. It's still a puzzle, but it doesn't satisfy Fama's overly strong possible view of what constitutes mispricing. So we're always left with this decomposition of do we have a bad model of pricing of risk, or is it actually mispricing? So the next thing that I'm going to do is just think about, could this be explained by rational models? Well, we have some rational models where the price of risk should vary over time. Campbell and Cochrane, if you know that paper, is one version of that. But that paper basically says how this time-varying risk aversion should be mapped into past data on consumption or GDP. That's something measurable that you could try to look at. It doesn't look like the empirical results are changed at all if we try to account for that. So it doesn't look like that specific model is going to explain what's going on. And a number of other things that kind of people have thought about in the literature, whether it's time-varying consumption volatility or the chance of kind of rare disasters, things like that, doesn't look like these things can easily explain the evidence. Now, again, we're only arguing against particular models. That's not to say that there couldn't be a model that would match this. One other fact that I think is useful in thinking about this view of potentially mispricing here is how dramatically these risk premiums reverse once we're in a crisis. So I showed you, everything I showed you was that the risk premiums looked really, really low in these credit booms on average. And credit booms predict a crisis. Now, once the crisis hits, there's a big reversal in all of these things. Credit spreads blow up. Dividend yield spikes as well. So there's a huge shift, it looks like, in the pricing of risk and in agents' expectations once a crisis actually occurs. Okay. So what explains the low price of risk? Can we make sense of it from the perspective of behavioral models? And I'm going to focus on models that think about past risk. So I'm going to think about the idea that maybe if risk in the economy has looked low for a period of time, agents might view the world as safe. They might view that quantity of risk as being low. Okay. Rationally, then they would demand a low risk premium from their point of view. They might also take a lot of leverage and extend credit. In doing so, that might build up a lot of fragility in the system. And therefore, the quantity of risk going forward might actually be high, even though it had been low in the past. Okay. So I'll just show you, I'm basically out of time, but I'll just show you some evidence on this. So this is what's on the left-hand side is future credit growth over the next 3 or 5 years. And then I'm regressing that on past GDP growth, past GDP volatility, equity volatility, and so on. Okay? And it looks like just because equity returns or housing returns have done well over some period of time doesn't imply that credit growth is going to be particularly high. But if equity volatility has been particularly low, that suggests credit growth being high going forward. Okay, and same with these behavior and the crashes of any one of these variables. Okay, main findings: credit growth negatively forecasts returns, positively forecasts risk. There's a major reversal of that behavior in a crisis. Whether or not it's mispricing, there's kind of none of this full smoking gun evidence of mispricing, but not easily explained in a rational model. One possibility that I think is worth exploring further is agents extrapolating from past risk generate endogenous fragility through risk taking, leading to higher chance of future risk despite actually seeing a low risk rate. Okay, thanks.
Okay, so is risk mispriced during a credit boom? So I'm just going to, this says motivation, I'm just going to start out by summarizing the reasoning in the paper because it's on one level simple, it's also a little bit subtle. So step one is high credit growth, predicting low stock returns. Now, the thing about predictability regressions is if you can predict stock returns, then you're basically saying something about ex-ante discount rates. So if stock returns are predictably low, that's sort of by definition saying that discount rates are low. Now, rationally, discount rates could reflect low risk, but what Tyler finds is that if anything, risk appears to be higher following a credit boom. So that's the reasoning in a nutshell. Okay, so now just to kind of talk a little bit about, why are we talking about risk being mispriced? Now, Tyler alluded to this. So asset prices do reflect the net effect of discount rates and expected future outcomes. So you could imagine that, discount rates were, let's just take for a moment the idea that risk really were high. You could say, well, maybe discount rates were correctly high, but expectations were biased. It's going to be hard to disentangle those two views. So, just to throw that out there, that's possible. So if we're talking about discount rates, it's really about risk. But if you have a market that's kind of approximately frictionless, if that's your null, which is probably true for the stock market, if not the housing market, or a reasonable null for the stock market, if not the housing market, then I think it's fair to kind of lump all of this in the kind of discount rate bundle. In fact, there's sort of asset pricing theorems to that effect. So we're going to talk about discount rates being low. We'll go with that. All right, so then this is kind of Tyler's main table for stock returns. He's looking at this 3-year ahead stock return. And these are the changes in credit, so over GDP, so credit growth. And you see that comes in reliably positive as a predictor of excess returns, even when you control for the dividend yield in this large cross-country database. Okay, so here, because there was a bunch of discussion about this sort of FAMA smoking gun point, I'm going to actually just make the point here that this is actually not exactly the equity premium. And so even the smoking gun isn't really a smoking gun. Like it's really the log expected return, and you can actually construct examples where this is negative even in a completely rational economy. So I think, but this paper doesn't actually rely on the FAMA critique, but that's just something to keep in mind when it is standard to use these, to use log returns for a bunch of reasons, but even if that is negative, that does not mean a smoking gun. Okay. All right. So notice first that the risk is being priced as stock market risk, not risk in credit markets. That's presumably the data, which is kind of interesting. That's the data we have. Of course, that's all right, because if it's really a risk mispricing story, if it's really a rational story, it really should be mispriced across markets. I guess some of the motivation comes from credit markets. So I think you can see this very dramatically in like credit spreads. So this is a CDX, an index in credit spreads, and this is like something I worked on a little while ago. But I really like these plots because you basically see during, I guess, what we now are calling this sort of boom period. These are tranches on the CDX. So CDX being an index of credit default swaps on investment grade corporate debt. You see, okay, zero spreads, and then enormous spreads. So that's kind of cool. I see Sam here. So Sam's done some nice work on this. So it appears that, if you look at if you sort firms and whether they're repayers or issuers during credit booms, the credit quality of repayers versus issuers, EDF being a credit quality measure, becomes kind of compressed. And then during recessions, the credit quality of repayers spikes, and you can tell you can think about this as basically during this period, sort of the markets don't really care who you are; they'll just issue you credit no matter what. Okay, so anyway, Sam's work says that if you look at this measure of dispersion, it's a very robust predictor of bond returns. Okay, so sort of that's a brief review of the fact that you do see these results in credit markets. Okay, so now back to the paper. Right, so the null hypothesis that the paper is sort of fighting against here is that maybe these low discount rates reflect low risk. Now, why would this be a particularly compelling null hypothesis to argue against? Well, actually, it works pretty well on some level, because if risk were truly low, it would actually be rational to issue more credit. So you might really expect to see in a rational model credit growth coinciding with low stock returns, because there's not that much risk out there, and so that means that projects, broadly defined, maybe projects are somebody's hardware store, corporate debt, somebody's mortgage. This idea that it's a good time to fund things when discount rates are low is kind of very much embedded in asset pricing. So you might expect to see low growth in credit corresponding with low discount rates. That's not crazy. So the good news is that maybe we can disentangle these two stories. And what I really like about Tyler's research agenda is that he actually really takes this seriously, which I agree with. And so you actually kind of look at what the kind of models for risk asset pricing has been providing and see, well, is risk low according to these models? And so in his job market paper, Tyler kind of uses this reasoning, looks at asset market behavior around financial crises, and shows that you can't explain it based on the Campbell-Cochran model or the long-run risk model, but because the risk, these models have predictable consequences for risk, and you just don't see it in the risk as those models say it should be measured. And this is a little bit more murky, and in this paper he focuses more seriously on this, having effectively dismissed the other two, and quite rightly, in my opinion. Okay, so equity crash risk would be one way to get at disaster risk. And so if you look at growth in credit, you see that growth in credit predicts higher crash risk, not lower crash risk. So according to a time-varying disaster risk story, that goes the wrong way. If you have low discount rates in a time-varying disaster risk story, then you should see lower risk, not higher risk. But he finds that equity crash risk is higher. Now, maybe there's a more subtle story one could tell, but sort of in a benchmark story, this is what you would find. I actually found this evidence on the dividend yield. I didn't know about this itself. Pretty interesting. So high prices, a low dividend yield, predicts a high crash risk. I thought that was also kind of interesting from the point of view of rejected models. Okay, so these are the results, kind of the novel results in the most novel results, I think, in this paper, arguing against a time-varying disaster risk story. GDP declines, looking at large GDP declines would be another way to go about this. Here, results are somewhat less significant, but it's a little hard to argue that the chance of GDP declines is lower following a credit boom. Okay, now, since I'm the discussant, I have to say something like push back on this a little bit. So here we go. Overlapping observations generate autocorrelations in the residuals would be one way to go here in terms of pushing back on this. What that means in English is that as soon as you do overlapping observations, you basically have less data than you think you have. Okay, now there's accepted as opposed to true correct. There are accepted ways of adjusting for this in time series. I don't know of accepted ways of adjusting for this in a panel, so we're still awaiting, I guess, the 10 papers in Econometrica on this, and then the 10 papers following those saying that they're wrong, but anyway. So, one way to go about this would be to do some Monte Carlos. Anyway, another way would just be to repeat it with one-year returns. So basically, these include the dividend yield, these don't. It could be because, obviously you're not picking up as much persistence, but with one-year returns, if you don't include the dividend yield, then you do lose some significance. So that's potentially an issue. if you have the dividend yield, interestingly, the significance stays. Now, I'm not sure there's a good reason to exclude wars. I mean, I understand the data is not so good. So I guess the problem is if you do 1-year returns as opposed to 3-year returns, you don't have the overlapping data, and you include the wars, then you have more of a significance problem. Only the 5-year credit, where you include the dividend yield in the regression, is still significant. Okay, now, whether the glass is half empty, half full here does depend on your null hypothesis. I'll come back to this at the end. Sorry about this misspelling. Okay, so comment 2 is a little bit more broad brush. Okay, I guess the sort of broad topic here is credit, good or bad. Now, there's this 2012 AER paper that shows that, forecast regression, high credit spreads, I was writing this on the train this morning, high credit spreads forecast high GDP growth, not low GDP growth, right? So for a long time, the academic battlefield was, firms are financially constrained, households are financially constrained, and so the financial markets aren't providing enough credit. And so some people, like myself or my co-authors, would push back on that and say, well, really, it's a credit demand, not a credit supply issue. You're not really successfully identifying financial constraints, but whatever. There was this big fight in seminar rooms about there's not enough credit. Firms are financially constrained. Well, okay, then it's like everybody decided to drop their weapons and they ran off to another battlefield, which said that, well, maybe we have too much credit. Now I guess they're related because the idea of rescuing banks is that, bad things happen when we deny access to credit. So in a sense, there's kind of this literature in the background where it's we don't really care. Why should we care about banks in the first place? We only care about banks if we want people to get loans. Otherwise, we don't care about them, I guess. Okay, so that's just something to keep in mind because you do have this literature, and so how do you know if the credit is good or bad? Because sometimes we think it's good. So a long time ago, I was playing around before. Your data set, I was playing around with the Reinhardt and Rogoff data, and I should probably repeat this. But anyway, we looked at crisis probabilities using sort of this method. This method is too strong a word. It was a very simple exercise, repeating something that Will Getzman did in a, I think, still unpublished working paper. And we just looked at the conditional probabilities. Crisis probabilities are very, very high in the Reinhardt and Rogoff data by some way they define it. The point is, if you look at 100% increases in a country's stock market, and you look at the change in crisis probabilities, well, you do see an elevated crisis probability following 100% stock market increase. But a lot of crises happen anyway, even without the increase. And even if there's an increase, that's the boom, there's still a 60% chance that there won't be a crisis. So to the point of the paper that was presented just before this paper, it's kind of going to be hard to do this out of sample. So to summarize, this paper offers compelling evidence of risk mispricing during a credit boom. I would say that the evidence that the risk is mispriced, that the stock market returns are too low. Okay. The evidence that the stock market returns are too low, I would say, is not airtight. However, it really depends on your null hypothesis. So from my point of view, if I'm interested in a disaster risk model, I actually think that this is probably sufficient, in all honesty, to reject a model of time-varying disaster risk. It really depends on your null. With the right, with a null, these tests do have really good power. I think it's extremely interesting from a scientific perspective. I think it's a great paper, very valuable to me. I'm not convinced yet as to its usefulness for policy.
Things worth thinking about. So the kind of patterns that you might expect for different asset classes depend sort of if you take a kind of integrated markets view or if you take a segmented markets view. And you could very well take the, it might be the case that conditional expected returns and credit are negative and they're not in the equity market.
Yeah.
And that would not, of course, in a frictionless, in a frictionless asset pricing model, that would not be the case. markets. The other thing is, and this is in, I don't want to place too much stock in this, but Robin and I do have in a paper that, for high yield bonds, the conditional expected returns on high yield bonds, kind of conditional on being in a pretty frothy credit market, are reliably negative.
I see.
So, unless you're willing to say high yield bonds are a hedge, which I don't even think Gene would, that's hard. And it's not it's not some Jensen's inequality adjustment thing, Jessica.
I mean, I don't know. It depends what we can talk about.
Well, no. They're big enough, and I think we can do it with arithmetic returns. It doesn't matter. So
to your point, I didn't look at in any of the things that I was looking at. You're basically getting at, is there relative mispricing across these asset classes, and kind of would you expect it more for credit markets
than
equities or other things? Yeah, I could try to dig at that more. Yeah, that's a good suggestion. I haven't.
Maybe I'm misunderstanding something very fundamental. You're looking at secondary markets, right? And you're assuming that a person buys in at one date and holds it to a year. But wouldn't you really have to look at individuals' portfolios to figure out if they're mispricing risk and how long they hold it? Because if I have an asset or I have some stock and I sell it to you because I think you're mispricing it, don't we have great heterogeneity among all the participants? I mean, that's what I seem to find in the 20s when I look at different markets, is that if you look at different agents, you see they have all different perceptions. And that the people who are driving the credit boom are the ones who are, have this optimism.
Yeah, so it would be...
That really this isn't quite what we want to look at, right?
I think it kind of is what we kind of want to look at, but I would think of this as, like when I'm talking about risk aversion or these things, it would be the effective risk aversion kind of wealth weighted of the agents that are in the market at that point in time. So if it's just the optimists that are holding the security and they're driving the price at that time, then that's effectively what I'm capturing. But yeah, I don't have any disaggregated data of everyone's different positions that I can use. So, yeah.
So just one comment on housing. You show there's a positive coefficient, but I think in our work and other work I've done, if you skip a year, the coefficient is actually negative. In other words, there's some sort of momentum in housing where housing sort of goes up when there's a credit boom for another year or two, and then it turns around and there's a big crash. So I think if you sort of looked at different time horizons, you would see a negative coefficient for housing just as you do on equity when you forecast returns.
Oh, I did have a negative coefficient for housing.
No, but you would have a negative coefficient for housing if you looked at a longer forecasting horizon.
Which is a little bit puzzling. It should be the most credit sensitive asset.
Yeah, because in the short run, credit pushes up house prices, but then there's a crash in the longer run. So you just have to kind of, because there's sort of momentum in housing prices, the credit boom will push it up before a crash in the longer run.
I see.
We could talk about
what
this.
regression you're saying for forecasting housing?
For forecasting housing returns, yeah. You show a positive coefficient, but that's just because of this horizon issue.
I think that one's negative.
We'll talk after.
Yeah. Conditional on credit growth being above the 90th percentile or whatever, housing returns were like 2% lower than average over the next 3 years.
Is there value in doing the very simple exercise of taking, whether it's a mortgage bond or corporate bond, and just looking at the actual lost experience over the next X years, doing a present value, and if at the time a bond was selling at a par or 105, but we know by the net present value after the loss experience that you would have, if you'd have known that, you would have only paid 80% of par. Isn't that the mispricing?
Yeah. So I can't do that because I don't have the data to be able to do it. That would be useful.
But for public securities, wouldn't you have that data?
I mean, it sounds like you're saying, like for stocks, you could do all the
Not for
future
stocks.
dividends and do the present value or
Well,
something.
it wouldn't work for stocks, but for a corporate debt instrument, a publicly traded corporate bond or a mortgage security.
I just can't get it going back to the time horizons that I'm looking at across these different countries.
Yeah.
But yeah, I agree, that would be valuable.